Hey guys, I want to go back to chapter 2 and discuss something that's extremely important in this class, T accounts. A lot of you might have skipped over this and not thought it was that important, but I cannot stress to you how important understanding T accounts is. You'll use it not only in this course, but you'll also use them when you get to 121 Managerial Accounting. So I want to review what a T account is and then go over one of the homeworks that you had involving T accounts. This is also going to be very beneficial for future homeworks as well. I always suggest getting out a scrap piece of paper and writing out T accounts. So going back to LO25, posting to the general ledger. To make the, once we record a transaction, we want to post the debits and credits into the individual accounts in the general ledger. The general ledger provides it in a single place each account with its individual transactions and account balance. The general ledger account includes the account title, transaction date, transaction description, and columns for debits, credits, and the account balance. So we see here an example of the general ledger account. So for example, Eagle issues common stock for $25,000 cash. As we know, cash is an asset. An asset is increasing because you're receiving cash, so we need to debit cash. And then credit stock is an equity account, and it's increasing. You have now issued more common stock than you did before, so we need to credit common stock. So our journal entry that we record is a debit to cash of $25,000 and a credit to common stock of $25,000. So in the cash account, we would have beginning balance of 0 because nothing has happened yet. It's the first year of business. And then we would also record the transaction 1 of issuing common stock for cash with the debit of $25,000 to give us a balance of $25,000. We see this dark line here. This is demonstrating what we're going to get to in a moment with T accounts. For common stock, we had a beginning balance of 0 because it's the beginning of the business, and we issued common stock, so the credit comes down here to the credit for an ending balance of $25,000. So as we go along with more transactions, we need to record each of those into the ledger. So for the next example, we borrowed $10,000 cash from the bank. We're increasing the asset cash, so we need to debit it, and we're crediting notes payable. We owe more now than we used to. Notes payable is a liability, so we will increase it with a credit. So going back to the account for cash, we'll record the next transaction with a $10,000 debit to give us an ending balance of $35,000. Our notes payable had a beginning balance of 0. We didn't owe anything. Now we've borrowed money, so we owe more than we used to. Credit $10,000. So our balance is now $10,000. As we go along, we see that we're going to record these in each account. So going forward, we're going to use a simplified version of the general ledger account, referred to as a T account. A T account includes the account title at the top, and then the left side is for recording debits, and the right side is for recording credits. So you'll see that for up here where cash is, we've dropped off the description and the balance column, and now we just simply have cash, the 2 debits we recorded, and the balance of $35,000. Notes payable is on the credit side, $10,000 with the balance. The left side is always the debit, the right side is always the credit. So we'll continue along with each of these transactions, recording each one and posting them to the T accounts as we go. So take a look back at these and review how these are posted in the T accounts. Once we are finished with all of the transactions that are listed in the book, we see the summary of all 10 transactions and a summary of all of the T accounts. Assets equals liabilities plus stockholders' equity. So you see how we've posted both debits and credits to the cash account depending on whether we debited or credited in the actual transaction. Add all of your debits together, add all of your credits together, Find the difference. We know cash is an asset, and assets have a normal balance side of a debit. So we expect that the debits should be greater than the credits. So all of these minus all of these gives us the ending balance of $6,900. If you only have one thing, bring your balance straight down. Review this and make sure you understand T accounts. Now, in homework 3, you're told to consider the recorded transactions below, and you're given a list of 6 different transactions. It says in the required section, post each transaction to T accounts and compute the ending balance of each account. The beginning balance of each account before the transactions is listed below. Always, always, always start out by recording your beginning balance. So cash. Cash is an asset, has a normal balance of a debit. So in my example, cash has a beginning balance of $1,700. Accounts receivable. Accounts receivable is an asset. Assets have a normal balance of a debit, so I will record it on the left-hand side. Supplies. Supplies is an asset, so we record a beginning debit balance of $230. Accounts payable, we have to pay someone, is a liability. Therefore, the beginning balance is $1,800 on the credit side. Deferred revenue, remember, is a liability. Somebody has paid you for something, but you haven't yet provided the goods or the services. So we want to record the $130 credit. Service revenue, it tells you, has a beginning balance of 0. Remember, revenues have have normal balances of credits. So we want to make sure that we put the beginning balance of 0 on the credit side. And then expenses have normal balances of debits. So beginning balance of 0 on the debit side. Now that you have recorded all the beginning balances, go back up to the transactions and post these transactions to the T accounts. Transaction 1, accounts receivable has a debit of $9,100. So we want to go over here, choose transaction 1, and post a $9,100 debit. Service revenue has a credit of $9,100. So we want to click here for transaction 1 and put $9,100. The reason you're putting these numbers beside it is so that if you're looking here, you can go, okay, this is transaction 1. What was transaction 1 doing? Oh, we recorded an account receivable and a service revenue. Transaction 2, supplies has a debit of $1,450. So transaction 2, $1,450. We also have an account payable of $1,450. So transaction 2, $1,450. 3, cash and accounts receivable. So cash is a debit of $8,500, and accounts receivable is now $8,500. 4, advertising expense and cash. Advertising expense has a debit, so we want to go down here and choose 4 for $1,100. Cash has a credit, so 4 for $1,100. 5, accounts payable is debited and cash is credited. Accounts payable, so we want to record a debit for 5 for $2,000 and a credit to cash of $2,000. Lastly, 6, cash is debited $1,200 and deferred revenue is credited for $1,200. Now that we have posted all of these transactions, we want to go through and add everything up. So in our example, cash has a beginning balance of $1,700, and we have a debit for $8,500 and a debit for $1,200. So our total debits are $11,400. We have two credits, $1,100 and $2,000. So we have total credits of $3,100. Find the difference between your total debits of $11,400 and your total credits of $31,000. You get $8,300. So your ending balance is a debit of $8,300. Now, accounts receivable. Accounts receivable, we have a debit of $2,500 and a credit, and another debit of $9,100. So we have debits totaling $11,600. We only have one credit in the amount of $8,500. So subtract the $8,500 to get an ending balance of a debit of $3,100. Remember, we should have debit balances on these two as they are assets. In supplies, we didn't have any credits, so we simply add our beginning balance and our debit to get $1,680. So these are our assets. We expect them to all have debit balances. Accounts payable, we have two credits, $1,800 and $1,450. So our total credits are $3,250. We have one debit of $2,000. So subtract your debit from your total credits and you get $1,250. $1,250 is a credit. Remember, it's a liability, so we want to have a credit normal balance. Deferred revenue, we have no debits, so we add our two credits together to get an ending balance of $1,330 on the credit side. Service revenue. Service revenue, we had no beginning balance and we posted one credit, so our ending balance is $9,100 on the credit side. Lastly, advertising expense. We had no beginning balance and we posted one debit. So we should have $1,100 as our ending balance on the debit side. As you can see, I have everything entered correctly. I have all my green check marks here, so that means I have everything entered exactly as it needs to be. Remember, your debits have to equal your credits, so you could check yourself. Make sure that $8,300 ending in cash plus $3,100 ending in accounts receivable plus $1,680 in supplies plus your advertising expense of $1,100, you have total debits of $14,180. If we go back and add up our credits, $1,250 ending in accounts payable, $1,330 ending in deferred revenue, and $9,100 ending in service revenue, we, should have the same ending balance. Let's see. So I incorrectly added something. Let me go back. Cash has an $8,300 balance. Accounts receivable is $3,100. Supplies is $1,680.